Welcome back to the Fintra AI Growth Lab podcast. Today's episode addresses something every lender, entrepreneur, and business builder should be thinking about right about now. How do you grow when the market gets tougher? When rates rise, volume decreases, liquidity dries up, and many competitors start pulling back, most people go into survival mode. But some operators do the opposite. They seek overlooked demand, underserved markets, and smarter ways to expand. That's exactly what today's guest has done. I'm joined today by Joe Castillo of Castle Group Mortgage, a company operating across Texas and Florida with a mix of residential and commercial lending and a very distinctive growth strategy. Joseph's been building business in places many lenders ignore, especially in ethnic and minority home builder communities, also navigating the realities of commercial lending in a tighter credit environment. We're going to talk about creating mortgage growth in tough markets, why trust and language matter in lending, what commercial borrowers are getting wrong today, and how Joseph is building a team that can scale beyond founder-driven production. Joseph, welcome to the show.
Thank you. Thank you for having me. It's a pleasure to be here.
So tell me, starting out, let's start with the episode title, Where Others Quit, Creating Mortgage Growth in Tougher Markets. Why does that title fit your story?
Well, it's interesting. It fits my story because I was in the mortgage space. I started off in banking in the 90s, but got in the mortgage space and right before the crash, 06, 05, 07. And then I left to China after the crash. And I was in China for about 11 years, started a company there. But I came back and decided to renew my license. And I passed my exam again, renewed my license. I believe it was like July. I believe it was spot on July 2022. Now, anybody that works in the mortgage space knows that July 2022 is when the rates went from 3.5 to 7.5. So the month that my license renewed, I immediately thrust into that challenge, right? So now I have a license renewed. I'm back in the business full time because I just come back from China. And now we had I remember a statistic that month that 100,000 mortgage loan originators resigned. So, that's quite a bit. And so I joined when everyone left, and it was basically good luck. Good luck, sir.
So for you, hard markets are not just a test, they're also a filter. Give us a picture of the business today. What markets are you in? What kind of lending are you focused on?
Well, we lend in all different, everything real estate related, so we've had to divide our company up into little different divisions so people could memorize the guidelines and be on top of the new guidelines in the investors, what they're doing and what they're not doing. It's a lot of information considering all the different types of loans from government stuff, FHA, VA, Fannie, Freddie, to, private lending, non-QM stuff, to commercial stuff. It's just too much to know for one person. So we kind of divided some of it up within our company so we could be experts in one area, So I'm pretty much an expert in the conforming area and the government stuff. And our vice president, he's all into the, commercial stuff and equity raising and stuff like that. So we kind of divide up our divisions.
Well, that's an interesting mix because you have community-based residential work on one side and much larger, more complex commercial lending on the other.
Yeah, and they're all full of guideline restrictions, changes, investor requirements. So we can just be better professionals. We kind of divided up that stuff. And a lot of times I'll say, you know what, you need to talk to Anthony, or you need to talk to so-and-so. Not that we're, a 10,000 staff company. We're a small company, but we just want our people to be professionals, and really be experts in their areas.
So what changed most after the post-2000?
Well, that time just, traditionally loan officers, their bread and butter was refinances. Almost everybody, they made their entire living off refinances. And they were making a good living. People were doing six figures and, some over $1 million a year on the refinance market. So when the rates jumped up to 7.5, well, guess what? No one's trying to refinance into a 7.5%, loan from 2, right? Or from 3. So that completely dried up. So we became one of the only companies that I know of in the nation that was like 100% purchase market business. But I had no choice. It was 2022. People weren't trying to refinance into a higher rate, double the rate. So that was just kind of how the cards, how the lot fell for us. So we ended up developing out a purchase market that was, and so our book of business is like 99% purchase to this day. And now we got a little relief on the rates, so we're starting to pick up the refis, but it's like learning another part of the business, actually. Even though that's the main part of the business for almost all lenders for years, for us, that's a new part of the business is the refis. So we spent hours with our account executives at the banks saying, but what do you do with the escrow again? And so on. And, just trying to learn how to do refis, even though that was the principal, business that people have as a refi business.
Well, that's a powerful distinction, finding demand instead of waiting for demand. That's the change that you've made with your culture.
Yeah, that's what we had to do is find and create demand, create in a market. So that kind of goes right up my, that's really my wheelhouse is creating a market because, my background is ministry, church ministry, right? And I was a missionary in China. So you think you're not being very successful in China because everyone there is Buddhist or atheist, so I had to create the market for people interested in Bible, right? So same thing with purchase market. Okay, no one's refi now. Well, let me disciple people into home ownership.
One of the things that caught my attention is that one of the strongest parts of your business is your focus on first-time home buyers in ethnic communities. How did that become such a core growth engine?
Well, I think, it's kind of a divine setup, because I went to seminary, and my major was cross-cultural communication, which is basically the scholastic term for missions, right? So I became an expert in cross-cultural communications, and that carried over to China. In China, I started a company helping Chinese companies do business with the West, and helping them understand how we think and how to talk to us and how do you craft an email and don't be so abrasive, just going over the nuances, because America's going to be very straightforward. Don't get offended. So we would train Chinese companies on how to deal with Americans. So that was my major, and my life work is diversity, intercultural, as a missionary, 27 countries. And I particularly came to Houston after COVID. We left China, came to Houston because of the diversity. Fort Bend County, which is the area that I live in. My office is in Houston proper, which is Harris County, but it's very diverse. We have all kinds it's the most diverse county in America, actually, Fort Bend County. So it really was a hand in the glove type of experience. I was used to love to travel the world, deal with different cultures. I used to go sit in the dorm rooms with Somalians and drink their tea, and they would be sitting on the floor Indian style. And so I'm just used to being able to get along with which to an American would be a very different, weird, strange environment. I enjoy learning that and getting to know them. And one thing I learned over all those years with all these different races, I was with North Koreans. When I was in China, I used to have a special outreach to North Koreans. The thing that I learned was that people, bottom line, they're humans. Like guys like to smoke, gamble, and women everywhere in the world. No matter the religion, so people are the same everywhere. And so coming here, saying, okay, the refinance market's gone. Americans are watching the news. They're afraid to buy. They're waiting for the rates to drop. God knows when that would happen. What about all these minorities that are here flooding, the Latinos and Pakistanis, Indians, Chinese, Vietnamese, all these people that have come across the border, so to speak, over the last couple of years that are renting? How could I teach them how to establish credit, build credit, and get them to be homeowners and get a part of the American dream?
So it was more than a marketing idea. It became a real operating strategy.
It turned into our entire strategy, our entire operating strategy. And I started hiring that way. So I would advertise, I'm looking for a Pakistani person that speaks Urdu and whatever Hindi that would like to be a loan officer. And so I would take people that are looking for a career and that spoke the languages I want to target, and I bring them into our system, train them, get them licensed, teach them how to be loan officers, because they're going to reach their church, their synagogue, their mosque, their temple.
That's one of the most interesting aspects of your model. You aligned loan officers with community languages. Why is that so powerful in your presentation?
Living abroad, especially in China, if you're in the Starbucks and you hear English, you turn around right away and you look, oh, who's speaking English? Hey, where are you from? You just light up, you get excited.
That's a
When a
fact.
Filipino is in America and they're at Starbucks and they hear somebody talking their language, right away they light up, they get excited, they want to go talk to them. I realized through that experience that people, when they hear their own language, there's instant trust. And when people are talking to an American and they're from a foreign country, there's all these insecurities, there's all these fears. Even, do they understand my accent? Maybe they don't understand what I'm thinking. So you got mindset situations. People have different mindsets from different countries. Communication barriers. They might not understand what I'm really trying to say, And then there's also comfort levels. People feel more comfortable with somebody who they feel can understand them. So there's three major factors and why someone would choose, if they're from Nigeria, why they would choose a Nigerian loan officer versus an American.
So your hiring model became part of your growth strategy.
Correct.
So you talked a lot about learning from a competitor. I remember our conversation, who built a very large business by focusing deeply on one ethnic market. What did you take from that conversation?
Well, I realized that, okay, it took me a second to recall what the competitor was, but now I know. Yeah, I learned from that particular competitor that he built up his whole business reaching an unserved market. There's a book called The Blue Ocean Strategy. It's a famous book that inspired a lot of entrepreneurs, even like Patrick Bet-David is a podcaster, that inspired him to go after women in the insurance industry. Well, this guy, he went after the Vietnamese people in California because he realized our people pay their bills, they have good credit, they have a lot of cash, but they don't know how the banking system works. So he serviced that community and he grew to being, I think he's one of the top 5 wholesale brokers in America. And now he has different races there, but he focused on that. And I said, well, if he could do that with one race, I could do that approach with 6 or 7, 8 different races and kind of build within their communities.
So you borrowed the principle but expanded the model.
Exactly. I expanded the model because he was Vietnamese. I'm not Vietnamese, right? So I'm American. I'm a typical American. I'm like 7 different races, right? I'm Italian, German, Irish, Norwegian, Guatemala. I'm so many different races. I don't have like my own people to reach, but I'm multicultural. And I said, let me just develop and expand it to different races and service this community. So even in some of our advertisements, I put the different flags in the different countries and stuff that we serve and languages that we speak, and I advertise that direction too.
It's an interesting prospect.
For realtors. A lot of
Yes.
realtors, especially in the old guard, are just, Americans. They've been in the business for 30 years. They're sitting in their open houses. They've got all these foreigners coming in, and they're really uncomfortable. So when I go into an open house and I talk to realtors and say, hey, next time you have a Chinese person come in, let me know. Call me up right away. I speak Chinese. Really? Yeah. Or if you have a Nigerian or a Vietnamese, who usually comes in here? I'll have a loan officer that will directly get them pre-approved for you. So even the realtors get excited about that.
That's an excellent idea. When you talked about your residential business is mostly purchase-based today, but you're starting to seeing more refinance starting to grow recently. How are you looking to try to balance the two?
Well, people always are shocked. When I say people, I mean the account executives at banks. When they call me up and they say, hey, we want to work with you guys. Tell me about your business. And I say, we're almost all purchasers. Like, what? You don't do refis? And I just explained to them my story. And I said, but I do want to develop that. So we actually have started developing that over the last couple of months. And we started with an ad campaign. So now we're doing an ad campaign on social media, and it's working. The leads are coming in every single day, and we're giving those leads out to our team at no cost. But no cost to them. I'm paying for the leads, right? But I want to see them succeed, so I'm doing that right now. But we're doing HELOC, cash out, because rates are lower and people have a tremendous amount of equity. So professionals in the mortgage space now, they're all talking about the fact that people have more equity now than any time in American history. The COVID crisis, during that time, values skyrocketed. So people bought homes for $200,000. Now they're worth $500,000 in just a couple of years. So people have a ton of equity, but at the same time, they also have a ton of high interest credit cards, and their salaries haven't gone up. And inflation has hit them. Groceries have gone up. Gas has gone up. Everything's gone up but their salary, but they have equity. their equity has got up. The compensating factor is tap into that equity, pay off those credit cards, maybe pay off that car loan, take that 5-year car loan, stretch it over 30 years, and increase your monthly cash flow now, your monthly cash after bills, boost that up a couple $1,000s. So that's the huge opportunity in America now. And so we were saying, you know what, we haven't developed that market. Let's develop that. So we're running ads now. I brought in a marketing guy a few months ago. He's running ads, and we're spreading those ads out to our team, and we're letting them start to work.
So this new strategy is going to make you look more stable versus businesses who had always built their operations strictly on refinance.
Yeah, I think ideally, I'd like to be 50-50 purchase and refi. I feel like that just creates greater stability for our company.
Let's talk about the commercial side of your business. What are borrowers most often underestimating in today's environment?
Well, most of the commercial stuff and I'm excited about the commercial stuff because Anthony's really heading that up, my VP in Dallas, and he's gotten into a little bit of your space, your background, and I downloaded your book and I sent him your book to buy too, because
Thank you. It's nice of you to do that.
Yeah. I mean, I learned from the best, right? It's a new market for us. It's a new business, a new field. He's raising equity now for investors, right? So for him, he's really starting to deal with all these investors that might want to, put some of the money into some of these bigger projects, like, multi-million-dollar projects overseas for like resorts and hotels and these type of things like that. So he's learning, he's getting his teeth cut right now. And he sent me an email yesterday. He said, hey, get me a list of all the people, high net worth people, so we can see if they want to, and I'm like, I don't even know where to begin with that. My people, when they call me up for a commercial loan, they're usually sticker shock on the down payment requirement. They're thinking it's like a house. They could get in with 5%, 10%, 15%, but typically on the commercial lending, commercial loans really going to kind of start off at 30% down, right? So, and a lot of my guys are foreigners. So they say, hey, listen, I want to buy this office condo for $1 million. And I'm like, all right, you're going to have to get 300 grand down. And they're like, 300 grand. And I said, well, we could do an SBA, but nobody wants to do an SBA. I offer SBA, we could do SBA, but nobody wants to do it because SBA is long and it's slow on the paperwork. So if it's going to be 60 to 90 days to close on an SBA loan, that seller has all these other offers. Some people paying cash. They're not going to wait 90 days for you to close on your SBA loans. So not a lot of people want the SBA loans, but they're quite sticker shocked by the required down payment to go pure commercial.
So what you're probably saying is that strong-looking deals can fall apart if the borrower's financial position isn't liquid enough.
Yeah, and one of the things we're finding on the commercial side, which you're familiar with, I'm sure, is new to me, is we say I have a $100 million project and they need to come in 15, 20 million. We're finding a lot of high net worth people, they're not 15, 20 million dollars liquid, so that's something that I've been finding out, that it's parked in different places. It's not always liquid. So that's a learning curve that we've had too, is not be shocked by that. When we get a bank statement and the bank statement says they have 3 million and we need 15 million, we're learning not to get shocked by that and just kind of figure out, okay, how are we going to move things around, or how are we going to do cross collateralization to be able to put down what's needed on this project, phase 1 or phase 2 of this project.
What are you seeing across different commercial asset classes right now?
Well, as far as class business space, it seems like people have been holding their breath for a long time, waiting for it to come back, waiting for people to come back to the office, waiting for, these type of things, and really living off of the tax breaks. I have a couple of clients that own a lot of big A-class commercial offices around Houston, just kind of surviving off of the tax breaks, trying to push people to get back into the office. But I'm still seeing a lot of vacancies, and they're playing the game, But it seems like it's a tightrope. It seems like it's a tightrope to me, and it seems like you have to have a strong team to get your vacancies up, and you got to put your best foot forward. Some of this A-class property I was looking at, it's A-class, but the landscaping is not as up to date and as beautiful as some of the other buildings that are more full. So they really have to have a great management in order to see those vacancies fill in.
So you probably agree if A class is having that kind of trouble, the B and C class commercials really got to be struggling.
Yeah, absolutely. For someone who's trying to get into that market, they better make sure that they have enough capital to turn those buildings around and get them up to speed. Because the competition is the market, I should say, not the competition. Well, market and competition both, is very tight now.
You talked earlier, and I'd like to touch on this a little bit. One of the smarter growth moves that you've mentioned is delegating more of your loan origination work. Why was that so important for you?
Well, we want to do, the name of the game is do more files, really. The whole broker channel really exists as an extension of the banks that don't know how to get into the community and don't know how to build relationships, and they're just waiting for people to walk into the building. So that's the thing with the broker channel. The brokers are at the soccer games, at the hockey games. They're in the community, they're in the churches, and they're commission only. So they have high incentive to have these conversations. So the banks are failing horribly at that. And maybe in the next 5 years, we'll see a lot of banks completely stop their mortgage origination services and go completely to the broker channel. That's what we're seeing in the next 5 years. So being in our channel as brokers, the more apps you can take, the more people that you can pull their credit, get them pre-qualified. That's really the name of the game, not sitting around doing all the paperwork and pushing the pencil, so to speak. And so you want to have a good team, whether it's a processor or an assistant, so on. So we started an assistance program so they can make a little bit of money and learn and get trained, and then also relieve the people who are in the community getting loans. So our loan officer assistance program is basically be trained, learn how to be a loan officer. But for us, it's basically clearing our plate of all the busy work. So we could stay in the cigar lounges, stay at the golf games. We could be in the places with ordinary people, having those conversations, making those relationships, getting those apps. While the assistants, they'll make a few bips, a few basis points, whatever, but they're learning the business. They're learning how to do the behind the scenes, and they could do the busy work that's on the computer.
Let's assume, because it's mostly true, that we have some loan originators listening to our podcast today, and they're struggling in this market. What would you tell these people?
Well, I would say, because I deal with this every week. Every week I do a lecture, a talk, a coaching for our team, and the biggest problem I see is inaction. It's like sometimes with some people, not everyone, but sometimes you're just talking to the wall, right? You feel like you're preaching to the choir, you're talking to the paint, but it's action. If you're not doing you have to do the basics. You have to, knock on doors, kiss babies, you have to do those things, right? So if you're a loan officer watching, there's no secret. Matter of fact, there was a very funny post. There's a loan origination software that they have a Facebook group, and I don't know how I got on it somehow. And they wrote, how many leads does your company send you? This is what the post said. And it's funny because I'm providing leads, something I started doing. And so I wanted to read the thread. And the thread went on, page after page after page, like leads. Are you kidding me? Who sends you leads? Nobody sends you leads. You got to get out there yourself. And everyone, one right after another, said the same thing. You got to get out there yourself. You got to talk to people. You got to pass out your card. You got to have conversations. You got to go to open houses. It's old school. It's the old, it's that old school like Trump. Just hitting the phone calls. That in the mortgage world, it's simply that. It's the old school, making the phone calls, knocking on the doors, going to talk to the people, going to open houses. That is the only way. That's the only way. It's the old school way. Get out there in the community, talk to people, ask for referrals, pass out your cards. If you can't get over that, this is not the business for you. So you really have to get over that mental hump, and you really got to be out there meeting people, talking to people. And that's what I do too. I'm an originating owner. And so my goal is within the next year, simply focus on the business aspect, not originate anymore. The reason I originate is because I'm earning the capital for our company too, for marketing and different things, right? But I'm phasing out of that. But when I'm focusing more on the business and my personal production gets a little bit low, I know what to do. get back up there, put a pocket full of cards, go back into the open houses, pass my cards out at the cigar club, at the Rotary Club, at the Chamber of Commerce. I know what to do, and it's always get back out into community, talking to people.
That's an amazing message, and that is probably the core message of this whole episode, is how you've taken a very difficult business model and turned it into a very successful outcome. Joe, this has been a great conversation. What stands out to me is that your business isn't just surviving a hard market. It's using the market as a forcing function to become sharper. Sharper about where demand lives, sharper about trust, sharper about community, and sharper about how to build an organization that can scale. For anyone listening, the lesson here is simple. When conditions get harder, the answer is not always to pull back. Sometimes the answer is to go deeper into the underserved communities, deeper into the specialization, deeper into the work of building something real. Joseph, your story has been inspirational to me. I really appreciate you joining us today.
Thank you for having me. And my greatest fear is the market's doing great and there's a ton of business, because that causes us to get lazy. So I like the fact that there's that pressure to keep you pushing, to keep you, going back to the basics, because that's the foundation of this business. Thank you.
And thank you for all who's listening. This has been Where Others Quit, Creating Mortgage Growth in a Tough Market. If you enjoyed this episode, share it with mortgage professionals, loan officers, brokers, or entrepreneurs who needs a better way to think about growth when the markets become uncomfortable. We'll see you next time.